Have you ever pondered the stark difference between assets and liabilities and how they can shape one's financial destiny? Let's delve into this great divide. An asset, simply put, is anything of value that you own, possess, or control that has the potential to generate future economic benefits. These can take various forms, from tangible assets like real estate, stocks and bonds, to intangible assets such as skills and education. The beauty of assets lies in their ability to appreciate over time, generate income, or provide opportunities for growth. They're like seeds that, when nurtured, can grow into mighty trees of wealth. On the other hand, we have liabilities. These are financial obligations or debts that subtract from your wealth. Think of liabilities like loans or credit card debt, which require ongoing payments and interest. They're akin to holes in your pocket, gradually draining your financial resources. Imagine you're on a boat in the middle of the ocean. Assets are your sails, catching the wind and propelling you towards your destination of financial success. Liabilities, however, are like leaks in your boat. If left unchecked, they can sink your boat, submerging your dreams of financial prosperity. In the grand scheme of things, the key to building wealth lies in striking a balance. It's about acquiring and managing assets wisely, allowing them to appreciate and generate income. At the same time, it's about minimizing liabilities to avoid financial strain and enhance overall financial well-being. The strategic acquisition and management of assets, coupled with minimizing liabilities, form the pillars of financial success and prosperity. It's about navigating the ocean of financial opportunities with a sturdy boat and strong sails, while diligently plugging any leaks that may appear. The world of finance can be a complex maze, but understanding the fundamental difference between assets and liabilities can illuminate your path. It's like having a compass in the financial wilderness, guiding you towards wealth and prosperity. Understanding this difference is the first step to financial freedom. And with this knowledge, you're already on your way to sailing the seas of wealth creation with confidence and clarity. Let's delve into the contrasting journeys of two individuals, one who mastered the art of investing in assets and another who was crippled by liabilities. In the heart of the bustling city lived a man named Benjamin. Benjamin was no different from the ordinary person, but he had a knack for understanding the value of assets. He was just a regular office worker, but he made a conscious decision early in his life to build his wealth by investing in assets. Benjamin started small. He saved a portion of his salary and invested in stocks. He learned to understand market trends and was patient, knowing that stocks are a long game. As his portfolio grew, so did his financial knowledge. He then ventured into real estate, buying properties in promising locations and renting them out for a steady flow of income. Eventually, Benjamin even invested in a small business, expanding his reach into the realm of entrepreneurship. Over time, Benjamin's assets grew. His stocks appreciated, his properties increased in value, and his business thrived. Benjamin was not just an office worker anymore. He was an investor, a property owner, a business owner. His assets were working for him, bringing in more wealth than his regular job ever could. On the flip side of the coin, we have Gary. Gary, like Benjamin, was an average office worker. However, instead of investing in assets, Gary was consumed by liabilities. He lived a life of extravagance, always buying the latest gadgets, dining at the finest restaurants, and vacationing in exotic locales. His credit card bills piled up, and to pay them off, he took out loans, which led to more loans. Gary was caught in a vicious cycle. His liabilities, his loans and credit card debts, were draining his resources. The interest alone was a heavy burden, eating away at his income. Instead of building wealth, Gary was losing it bit by bit to his mounting debts. While Benjamin was enjoying the fruits of his assets, Gary was sinking deeper into the quagmire of liabilities. Their paths were as different as night and day. Benjamin was building wealth, while Gary was accumulating debt. One was moving up the financial ladder, the other was slipping down. So what can we learn from the tales of Benjamin and Gary? It's simple, really. Assets, whether they be stocks, real estate or businesses, have the potential to grow and generate income. They can work for you, bringing in wealth even while you sleep. Liabilities, on the other hand, are like a leak in your financial boat. They drain your resources, dragging you down into a sea of debt. These stories illustrate the profound impact of assets and liabilities on one's financial trajectory. What can we glean from these tales of wealth and woe? Let's distill some wisdom from these narratives. Assets and liabilities aren't just financial jargon. They are the fundamental building blocks of your financial landscape. Assets, be it real estate, stocks, bonds, or even your knowledge and skills, are your financial allies. They work for you, bringing in income, appreciating over time, and paving the way for growth opportunities. They are like the seeds you plant today for a bountiful harvest tomorrow. On the other hand, liabilities are your financial adversaries. They are the loans you owe, the credit card debt you carry, and any financial obligation that drags you down. They're like the weeds in your financial garden, sapping your resources and stifling your growth. The key to building wealth doesn't lie in amassing a fortune overnight. It's about the strategic acquisition and prudent management of assets. It's about planting the right seeds, nurturing them, and watching them grow and flourish. And while you do that, it's equally important to keep an eye out for the weeds of liabilities. Minimizing these is crucial for maintaining a healthy financial garden. But remember, not all liabilities are bad. Some, like a mortgage for a home that appreciates in value, or a student loan for an education that increases your earning potential, can be beneficial in the long run. It's all about managing them wisely and ensuring they don't overrun your assets. So what's the secret sauce to wealth management? It's striking the right balance, a balance between assets that generate income and appreciate over time and liabilities that are necessary but managed wisely. It's about making your money work for you, not the other way around. Remember, the right balance of assets and liabilities is the cornerstone of sustainable wealth management. And with that, you're well on your way to scripting your own tale of wealth and prosperity. So how do we navigate this path to prosperity? Well, let's start with the basics. Financial literacy is the cornerstone of wealth creation. It's about understanding the nuances of assets and liabilities and how they impact one's net worth. It's about knowing the difference between a good debt and a bad debt, between assets that appreciate and those that depreciate. But knowledge alone isn't enough. It's the application of this knowledge that truly matters. It's about making informed decisions, about being strategic in acquiring assets and prudent in managing liabilities. Consider this. You're looking to invest in real estate, a tangible asset that typically appreciates over time. But you don't jump in blindly. You do your due diligence. You study the market, the location, the future growth prospects. You calculate the potential returns and the risks involved. You consider your financial capability, the loans you might need to take, and the interest you'll have to pay. And that brings us to the next point. Disciplined spending. It's about distinguishing between wants and needs, about prioritizing and making sacrifices. It's about understanding that every dollar spent on a liability is a dollar less to invest in an asset. It's about knowing when to say no, even when the world is screaming yes. But remember, it's not all about numbers and calculations. It's also about patience and perseverance. Assets usually take time to appreciate, to generate substantial returns. Liabilities, on the other hand, can add up quickly and become overwhelming. The key is to keep a balanced perspective, to stay focused on the long-term goal and not get swayed by short-term hurdles or temptations. So let's recap. To navigate the path to prosperity, we need financial literacy to understand the dynamics of assets and liabilities. We need to be strategic in acquiring assets and prudent in managing liabilities. With strategic asset acquisition and vigilant liability management, the road to financial freedom becomes less daunting. So, why does understanding the difference between assets and liabilities matter? It's like knowing the difference between the accelerator and the brakes in a car. One propels you forward, the other slows you down. In the journey to financial security, assets are your accelerator. They propel your wealth upwards, generating income, appreciating over time, and opening doors to growth opportunities. Liabilities, on the other hand, are like brakes. They slow down your wealth accumulation, draining your resources with ongoing payments and interest. The power to build wealth lies in your hands, and that power is amplified by financial knowledge. It's not something that's taught in schools, but it's something that can change your life. Investing in your financial education allows you to make informed decisions, to know when to accelerate and when to apply the brakes. Armed with financial knowledge, you hold the power to shape your financial destiny. Remember, wealth is not just about money, it's about financial freedom.